All right. Today is Monday, January 24th. And this is a recap for the stock market activities today. What a day, what a day, what a day. The Dow Jones at some point of the day was down as much as 1,000 points. And by the end of the day, the Dow Jones closed in the green. A roller coaster ride like we have never seen before since the financial crisis. We're going to talk about all of this and a lot more. The problem is, I always say that I got a good one for you tonight, and I do, but this time around it's going to be short and sweet. And the reason is, just for new viewers, this is my part-time job. I do have a full-time one, and in days like this, we get really busy. And I know what you're going to say, how do you manage to do all of this by yourself? The answer is, I'm a fast-paced kind of person. I think fast, I act fast, I write fast, I move fast. Matter of fact, my nickname in the office is Roadrunner, which also happens to be my nickname in the bedroom by my wife for other reasons. Anyways, another question you people keep asking me, how do you manage to make the stock market and financial news, the economy, so funny? And I say this is the best freak show on the planet, not this channel, but the economy and the stock market. Look at the action today alone, down 1,000 points, and then it recovers all of that. You're not going to find this kind of action even in Netflix. This is the best freak show on the planet, and in all honesty, it is really a dark comedy when you think about the economy and the stock market, because it's going to end in a tragedy. All of that financial engineering by the Fed will blow up and fire back. And we're all going to pay the price. In the meantime, it is highly entertaining. But let's start with this. Inflation is sky high. You look at everything from gasoline to food to used vehicles to housing to appliances to clothing. Prices are surging out of control. The most intense inflation we've ever had since the 1970s. And it is starting to become alarming. And the Federal Reserve is attempting to react to this inflation by tightening the monetary policy. The problem is, by tightening the monetary policy, they're going to blow up the stock market and perhaps the economy. I look at Jerome Powell with a dumb look on his face. Oh, did I cause all of this? Yeah, you did. And today we got bad news for the economy and for Jerome Powell because he's backed into a corner between a rock and a hard place. To add more to the misery, today we got the manufacturing and the services PMIs. And guess what? They're down big. What does that mean? The pace of economic activity in this economy is slowing down dramatically. Now, we can pin that on the Pokemon variant because that's convenient. But we gotta know the true strength of this economy after the variant is gone, which is, spoiler alert, it's not going to be that good. The consumer is running out of ammo. They already exhausted the stimmies, they exhausted their savings, and now they're swiping those credit cards up and down, up and down, up and down. What happens after that? Specifically when the stock market starts to go down and we start to see job losses in this economy. And oh, by the way, with inflation sky high and the Fed has to tighten to combat that, it is the worst case scenario. I know what you're going to say. Well, if the demand is going to slow down and the Fed is about to tighten, then inflation is going to be gone. Have you ever heard about a phenomenon called stagflation before? Anyhow, when we look at the market composite PMI, as you can see, we have a high degree of correlation between the PMI composite and the GDP of the country. And right now, the reading of the PMI is diving down in an incredible fashion, which means that the GDP will take a massive hit in the fourth quarter of last year and perhaps the first quarter of this year. But it is important to put everything in perspective, and for that, we have to read what Chris Williamson said in the report today. He says soaring virus cases have brought the U.S. economy to a near standstill at the start of this year, with businesses disrupted by worsening supply chain delays and staff shortages, which new restrictions to control the spread of the thing, adding to firms' headwinds. And by the way, notice how we have to maneuver with the wording and all of that, because God forbid, the robot police might get upset. As if we're living in North Korea, by the way, not the United States of America. But anyways, Williamson adds, however, output has been affected by the Pokemon much more than demand. Hold that thought, because it's interesting, but here it is, continuing. With robust growth of new business inflows hinting that growth will pick up again once restrictions are relaxed. Furthermore, although supply chain delays continued to prove a persistent drag on the pace of economic growth linked to port congestion and shipping shortages, the overall rate of supply chain deterioration has eased compared to that seen throughout much of the second half of last year. This has in turn helped lift manufacturing optimism about the year ahead to the highest for over a year, and has also helped bring the rate of raw material price inflation down sharply. Thus, despite the survey signaling a disappointing start of the year, there are some encouraging signals for the near-term outlook. Now, if Williamson is right that the Pokemon variant is hitting supply more than demand, and the demand is still intact in this economy. He also says that raw material supplies, or prices, went down. You add 2 and 2 together, and you can attribute the slowdown in economic activity due to the Pokemon. Once it's gone, since demand is still intact, we told you that this inflation is a demand problem, not a supply one. The supply is secondary to the demand inflation, aka the monetary inflation. But if the demand is still intact, then inflation will resume moving higher once again after the variant is gone, which could be good news for the economy because the pace of economic activities will move higher again, but bad news for the stock market because higher inflation means that the Fed will be more aggressive in their tightening policy. Now, it will be really interesting to hear what Jerome Powell thinks of this report. Does he interpret it as inflation is cooling down, or holy shit, inflation is about to pick up again once the variant is gone? And if it is the latter, then Jerome Powell has no other choice but to crash the stock market by being too aggressive in tightening the monetary policy. Now, let's talk about the market action today, and let's hear what I said last week about the expectations of a bottom and an upcoming rebound in this market. Take a listen. I'm waiting for a sign that the market has bottomed, at least for a few days or perhaps weeks. And that's not going to happen until we get one of two things. Number one, the nasty, ugly gap down opening with higher volume, and then a reversal and closing off the lows. That's number one. Number two, if the fundamentals, meaning earnings, specifically from the big cap technology stocks, come out pristine, then the market can find a reliable bottom. And scenario number one took place today. We opened down big and the selling intensified with higher volume. And then came the rebound, erasing all of the losses, closing in the green with higher than average volume. Now, I also talked about this in last night's video, but I tweeted it too. Today, conditions for a bottom. The 10-year yield cooling down, the VIX cooling down. Number 3, buying the dip on higher than average volume. Number 4, a surge in call options buying. At the time of the release of this tweet, only one condition has been met, which is the 10-year cooling down. Throughout the day, I walked you like a baby, holding your hands, showing you how to trade this market. I tweeted this. On the 5-minute chart of the VIX, we're seeing a topping formation, meaning condition number 2 is about to be met. We have the head and shoulder formation. And once that took place, you saw the high beta name, the beaten down names, the high multiple names, the likes of RKK, for example, moving higher. And then I tweeted this. After the VIX went down and the head and shoulder played out, I said, watch out for 33. If we see a rebound from 33 around that number, then you will see the selling resumes. And this is exactly what happened. The moment we saw a rebound from 33, names like RKK flushed down or went back to the red. And then by the end of the day, the VIX lost 33 once and for all. And that initiated the massive rebound rally that took place in the market by the end of the day, because it appears, at least for now, that the VIX marked a top, a short-term top. We also saw the buying coming in with higher than average volume, which means that the majority of the buying happened via short covering. The shorts are booking profits. I closed all of my NASDAQ shorts that I've been holding since December at 397. And the reason is, number one, why be too greedy when you won big? Number 2, we're about to head into an FOMC meeting. Who knows what Powell is going to say? Number 3, we have massive earnings coming out for the big technology firms. What if the earnings come out good? That will pause the negative action in the stock market. We have yet to meet one condition, which is a surge in call options volume, which will confirm retail participation in buying the dip. We haven't seen that yet, which once again affirms that the buying that we saw in the market today mostly happened via short covering, which is a normal process of any bottoming action, any rebound rally. It starts by shorts covering. Then comes the institutionals buying. And after that, the retail crowd, specifically the experienced traders. And then comes the mom and pop retail traders, the gamblers and the likes, pretty much at the end of the rebound rally. So we're going to keep an eye on all of that I'm going to discuss the charts with you, earnings, and everything. So watch all the way till the end of this video. But I'm going to keep it short and sweet once again because today was a busy day for me. So we're going to skip the coverage all the way by starting with the charts analysis, and let's do that by the SPY's chart, the S&P 500 30 minutes chart. What's going on here? The SPY opened gapping down big, and it was panicking in the morning, high volume. But you and I, since you've been listening to this program for a while, you and I have been anticipating a rebound and a bottoming process. But I told you, look at all of these support lines. And these lines, by the way, been on the chart all along. I don't draw the lines on the day where it happens. These lines been here all along. And I told you, the lines don't really matter. And the reason is we're seeing a flush down in the market. So you have to wait for the charts to pick which number it wants to rebound from. And in the case of the SPY, it decided to have it at around 422, which is my number. The exact low was around 420.7. And perhaps by the time the chart traded around 420, the bears decided that their profits are too high and they decided to book them. But in any case, the RSI was severely oversold. The writing was on the wall that we're about to see a rebound. And we got that today. Now, look at how many support lines got recaptured today. 430, 434. 438, and on top of that, the chart managed to close the gap that it created in the morning. The question is this bullish or bearish? The answer is clear. It is bullish. Now, at the end of the day, you know that this rebound will be a sucker's rally. It will be a bull trap once again until and unless the Federal Reserve changes its hawkish policy. And that's not going to happen unless we get a new piece of information that point out that perhaps the economy is slowing down dramatically and inflation, most importantly, is going down in a big way. We have yet to get this kind of information. Now, let's move on to the daily chart for the continuous contract for the SPY, the S&P 500. But before we do that, let's hear what I said about it last night. Take a look. But I would be more confident if we opened down on Monday, gapping down big all the way to 4,232, and we see extreme oversold readings on the RSI. If that happens, I'm going to buy the dip with both hands. And indeed, this was the right call because the SPY's futures rebounded from 4,232 almost to the penny. We became really oversold on the RSI, the MACD indicators, all bottoming for now, and the buying came out at higher than average volume. You look at the candlestick pattern, the massive rebound. You combine that with oversold readings on the RSI and the MACD indicator, and on top of that, the buying took place today on higher than average volume. You stitch all of that together. The risk versus reward says the majority of the gains from shorting this chart are already done, and the risk versus reward suggests that you should be long here playing a rebound, at least. Now, you gotta be cautious here because we have many landmines that we could step on. Number one, what if Jerome Powell doesn't budge and maintains the same aggressive hawkish stance on tightening the Fed's policy? Number two, the tensions between Russia and Ukraine. The invasion could happen any minute now. We're seeing US and European diplomats evacuating from Ukraine, paving the way for an upcoming invasion by Russia. If that takes place, oh boy, the market is going to crash again. Perhaps we're going to see a massive pop in energy futures, pushing inflation expectations higher again, which will mean that the Fed will have no other choice to be more aggressive on the monetary policy. Meanwhile, we have a slowing economy. And on top of that, we have massive geopolitical destabilization between Russia, Ukraine, the United States, and the European Union. So you got to keep that in mind. But the technicals for now favor the bulls. What about a 30 minutes chart for the Qs, the Nasdaq? Look at that. Gapping down and then rebounding, erasing all of the gains, recapturing 352 as support, and on top of that, closing the gap it created in the morning. Is the action that we got from the tape today bullish or bearish? The answer is it is bullish. It's a massive reversal here, and it's done via short covering. The writing was on the wall because the RSI was severely oversold, and every time we have reached these kind of readings, we saw a rebound in the Nasdaq. Not to this magnitude, but you can bet on it. And look at where the chart bounced from. No support line by me at all. In no man's land. And I told you repeatedly, do not bet on any support line to produce the rebound. You gotta wait for the chart to choose where it wants to rebound from. And in this case, it chose to rebound from no man's land. Before we move on to the daily chart for the continuous contract for the Nasdaq, let's hear what I said about it last night. Take a listen. Yet we're getting closer to an oversold reading, so we are expecting and anticipating a rebound here. A rebound rally for days, for weeks, and once that becomes overbought, we're going to short again. You look at the volume is spiking higher. The explanation could be options expiration, but yet this is another sign that the bears remain in charge. And if we do gap down on Monday, meaning tomorrow, I'm looking at 14,000. And if that happens, I'm going to cover my shorts and I'm going to go long. And whatever happens, happens. And folks, please, I'm talking about trades. I'm not talking about my investment portfolio. My investment portfolio remains as is. I'm talking about my trading portfolio. And indeed, we got the gap down, a massive flush down all the way to 14,000. We pierced below that. But again, if you bought at 14,000, that was a good call because the Nasdaq recovered all the way and recaptured 14,445 as support once again. You look at the candlestick pattern. Is it bullish or bearish? The answer is it is bullish. You look at the momentum indicators. They're oversold, beaten down big, which is a contrarian indicator for the bullish side. You look at the volume. The buying, specifically in the last hour of the day, was really aggressive when it comes to volume, indicating that the shorts were covering aggressively. The risk versus reward says if you've been short, you should have covered today, and if you did not, you should cover tomorrow. And you should be playing the upside, the rebound, at least for a little while. All cards are on the table here. We have a lot of risks, so while you play the rebound, you gotta be really careful here because on top of the Fed and Russia, Ukraine, we have earnings. What if earnings come out disappointing? The outlooks in specific, when it comes to Microsoft, Apple, Tesla, the rest of them, the market is not gonna like it. A slowdown in growth, a slowdown in the fundamentals of these companies is the next shoe to drop. And it's going to be ugly. And therefore, did I buy with both hands, like I said? Not really. Shame on me, I know. But I did play the rebound via buying puts on the SQQs. Let's take a look at this chart. This is a daily chart, of course. Again, the selling in this chart happened on higher than average volume. Number one. Number two, the momentum indicators, be it the RSI or the MACD indicator, all overbought in this case, meaning using it as a contrarian indicator, the risk versus reward says the chart is topping and you get a bet to the downside. Book your profits and bet to the downside. When we zoom in to look at support lines, how about 36 for a target? Again, no guarantees here. You could wake up tomorrow in the morning and the Qs are down and the SQQs is shooting higher again, and therefore I used this strategy in playing the dip by buying put options on the SQQs. I did play intraday trades by buying calls on RKK and other names, Shopify, and then dumping them by the end of the day because you gotta stay cautious here. The wall of worry is simply too high. What about the IWM, the Russell 2000, 30 minutes chart? What's going on here? Rebounding from yet another number that was on the chart all along, 191.5. And he shot up higher, recapturing 196.5 as support and closing the gap. And we're now looking at 204.5. A big rebound from the bottom. It was oversold when we talk about the RSI. We're getting closer to an overbought reading this fast. Unbelievable. And what that means is if the IWM opens up gapping higher in the morning tomorrow and it's around 204.5, look at the RSI from a 30 minutes perspective. If it gets overbought, the risk versus reward says you gotta book some profits from this rebound play. Next, we have the dollar index. The Dixie, the daily chart, it is forming that bull flag, but it could go either way. It all depends on the Fed. The Dixie is being aggressive right now in an attempt to recapture 96 as support. When we look at the momentum indicators, they're all turning positive once again, reversing the negative divergence, be it the RSI or the MACD indicator. Interestingly so, those who were betting, the speculators, who were betting that the dollar is about to go higher, closed their bets for some reason. I mean, look at this. A massive dump. They bailed out last week. What are they seeing here? Why are they betting that the dollar is about to go down? Are they going to be right or wrong? Highly important. But it appears that we have a consensus here in fading the pop in the dollar, which perhaps suggests that the Fed will not be too aggressive as we anticipated before. We'll see. After all, these are speculators, not prophets. Next, we have gold. What's going on here? I continue to like gold. We have a formation of yet another bull flag, and it appears that the target will be the sloping line of resistance in yellow. I do like gold because regardless of what's going on in the market, be it the dollar or the 10-year yield or even the stock market indices, going up or down, gold since the beginning of the year, as we called by the way in this channel, continues to move higher, slowly but surely, steady Eddie, and I like the action, and I continue to be bullish on gold. And here's the daily chart for the 10-year yield. What do we mean by cooling down? I don't mean that the 10-year yield has to go down, erasing all of these gains to 1.5%, for example. All what I mean is that impulsive move higher has to stop. It has to cool down. We have to see some consolidation here. And this is exactly what we're seeing right now in the chart of the 10-year yield. Look at the MACD indicator, the RSI, the momentum indicators. They're cooling down. They got overbought, and they're now pulling down. If I'm reading the tea leaves correctly, the bearish outlook for this chart would be a formation of a head and shoulder. And you're smart enough to picture that without me having to draw on the chart. And I'm only saying that, by the way, because I forgot to make one. Anyhow, the bullish scenario says it's just a pullback, consolidation for a little while, building some energy before the 10-year yield pops higher again. And it's all going to depend on Jerome Powell. Here's a weekly chart for the TLT. Doesn't look good. This is the weekly candle, the first day of the week. The week is still young. Anything could happen, but it doesn't look good for now. It looks as if the TLT wants to go down all the way to 134.5. If that is the case, then the 10-year yield will pop higher, and that will not be good news for the indices, specifically the Nasdaq. So you got to watch this chart carefully. And here's perhaps the most important chart of the day, the VIX 4-hour chart. Look at how high and elevated the readings on both the RSI and the MACD got today. Way too high. Once again, a contrarian indicator that we're about to pull back. Now, this has been a highly reliable indicator, which is the MACD indicator from a 4-hour perspective on the VIX. Every time we see a crossing creating green impressions on the histogram, we see a double-digit pop in the VIX at a minimum and a pullback in the SPY. But at some point, the pop in the MACD has to top. Once it tops, you see the SPY moving higher. And this is exactly what we got today. You can confirm that the VIX has topped for good and the SPY has bottomed for good once the reading on the MACD crosses the negative territory from the 4-hour perspective, creating red impressions on the histogram. And of course, this serves as a confirmation because the MACD is a lagging indicator. So if you want to be on the safe side, you're gonna wait till the MACD from a 4-hour perspective and the VIX crosses the negative territory, creating red impressions on the histogram. But for seasoned traders, you're already going to spot the move ahead of time. For example, we switched to the 5-minute chart that I shared with you on Twitter. We got the head and shoulder formation. That was the early sign that a top is coming. The VIX flushed down all the way to 33, 32, whatever you want to call it, doesn't matter to me. It's a zone, and it bounces higher. And the Qs, the SPY, they all pull back. And then what happens? The VIX loses 33 once and for all, and that initiates the massive pop that we saw by the end of the day in the SPY and the Qs and the rest of them. Am I calling that the pop in the VIX is over? Of course not. For all you know, the VIX can gather some energy and it pops higher again. The ultimate confirmation will be a crossing in the MACD indicator from a 4-hour perspective, creating red impressions on the histogram. Similarly, look at the VXN 4-hour chart. It's a similar pattern. A head and shoulder formation, flushing down. It did not close the gap yet. This is a 5-minute chart, by the way. But again, once you saw the head and shoulder formation, it was a safe bet. The risk versus reward says perhaps we're going to see a rebound here in the Qs, and the VXN is going to go down. You got to be careful though, because the gap has yet to be closed, and if the VXN reverses higher again before closing the gap, it's going to be an ominous signal for market bulls, because it will say that the VXN is not ready to close that gap. It wants to go a little higher. Let's look at the 4-hour chart with the VXN. The MACD indicator, the RSI, went way too high. When you see these kind of readings, the risk versus reward says the VXN is going to pull back, and when the VXN pulls back, the Qs is going to rebound higher. On top of that, we're seeing a reversal candle from a 4-hour perspective. It did not close the gap yet, but the risk versus reward for now says the VXN has what it appears to be a top, and therefore the Qs have a tradable bottom for now. Moving on to Apple, what's going on here? A daily chart perspective. It is back within the channel, as we called, by the way. It's a decent candle, reversing all of the losses in the morning and closing at the highs of the day. Apple is going to report earnings on Thursday. We cannot wait till we get the earnings from Apple, because as Apple goes, so will the market. We're getting oversold here, but not severely oversold on Apple. So we could see more losses to come here, specifically if Microsoft's earnings tomorrow come out disappointing. And here's a daily chart for, not a daily chart, but it's an hourly chart for Tesla the souffle. It went down, breaching 995. We can also comfortably call that the gap at 939 is now closed. Look at where the chart went, by the way. It went all the way down to the trend line, and it rebounded from that point on. It became way oversold in the RSI from an hourly perspective, but look at the daily chart. We have a defined trend line on Tesla, and the chart today rebounded exactly to the penny from the trend line. We have earnings coming out. My expectations are you're not going to see massive buying here in all of these names, be it Apple or Tesla, that are about to report earnings. We have a little bit of fear going on in the market here when it comes to earnings after the reactions that we got from JP Morgan, Goldman Sachs, and Netflix. Who's to say that Tesla's not going to crash after earnings? And therefore, you're going to see a little bit of hesitancy here in buying the dips in these names. Lastly, what about tulips? BTC, Bitcoin. It is getting way oversold on the RSI, the MACD indicators, meaning we're anticipating a rebound here. It appears that we have a reversal candle, breaching below 35,750 and then recapturing that level for support once again. Is this action bullish or bearish? It is bullish. As we talked before, at around 42,000. The chart's going to consolidate for a little while, asking, any buyers, any buyers, any buyers? If the buyers don't show up, then the same thing will happen as we've seen from 42,000. The chart's going to flush down to the next support and see if it can meet buyers at that point. If not, it's going to form a bear flag and it's going to flush down all the way to 30,000 and perhaps it's going to find buyers there. So the buyers better show up right now. Otherwise, we're going down to 30,000. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the S&P Case-Shiller National Home Price Index. This will be highly important, highly critical for the housing market. And then we have the National Home Price Index, yet again, lagging indicators, but critically important for the housing market. And lastly, we have the Consumer Confidence Index. This will be highly important too, specifically with the shortages and shutdowns and workers taking a break because they're sick due to the variant, which pushed inflation higher. So we want to see how the consumer is reacting to all of this. And before we end, here's the earnings calendar for this week. On Tuesday, meaning tomorrow, we have Johnson & Johnson, Lockheed Martin, Triple M, American Express, Microsoft, and Texas Instruments. On Wednesday, we have AT&T, Whirlpool, Abbott Laboratories, Freeport-McMoRan, Boeing, Edwards Lifesciences, Lam Research, Intel, Tesla, and Las Vegas Sands. On Thursday, we have Kimberly-Clark, McDonald's, Visa, MasterCard, Apple, and Robinhood. And lastly, on Friday, we have Chevron and Caterpillar. A critically important week when it comes to earnings. Not just from big tech, be it Apple or Microsoft, but we also have Tesla, a representative of the high-growth, high-multiple names in the market and the retail crowd. We have industrial giants like Boeing. We have names that could reflect the health of the consumer, like Whirlpool, for example, or Visa, MasterCard. We have earnings that will serve as an indicator for inflation. Kimberly-Clark, American Express, Caterpillar, Chevron. And then we have other names, other earnings that will serve as an indicator of the health of the reopening. And here we're talking about Las Vegas Sands and once again, American Express. The action is about to heat up significantly. Buckle up your seatbelts. You haven't seen anything yet. The week is just starting here. And with that, folks, we're done here. This is all I got for you for tonight. Thank you for listening. Thank you for watching. And we'll talk to you again tomorrow.